on your screen there
Yeah.
there is a bunch of gray areas on your screen that are kind of coming through. It's probably where you've got some window overlays from Zoom,
Let's see.
but on here we can't see the
Maybe I'm
content
not
of that.
sure,
We
and
just
I
see
might
gray.
be not sure on the right one. Hold on. Let me try that again. Share screen two. Maybe the is it on the right hand side?
Well, it's all gone gray now.
Oh, I started to reshare. Let me
Yeah, let's
stand
see
by.
what happens.
I show two screens. There's a meeting screen and a Ken Long screen on separate tabs.
Ah. Yeah, the meeting
This
screen
is
has
weird.
everybody's image, and then KenLong's screen.
Yeah, stand by.
Yeah.
Let's try that one again.
Yeah, I think you're correct. There's a meetings tab on the upper panel. So if you select meeting, I think that's the correct one. Well, that's the one where can
Is
I
that
see
to
you?
me or to the people?
Yeah, if we use the meeting tab, then we can see folks from the meeting and also Ken
Okay.
yourself.
I see the screen now, full screen, and then
Yeah,
there are no gray overlays, so it
yeah,
all looks
yeah.
good.
I think yeah. It had the I had the video and the chat window floating on that same screen that had the presentation, and maybe that was.
Yeah.
And sometimes what I have noticed is if you run Zoom in a using the web app as opposed to the app itself, you can sometimes the video and audio gets monkeyed up. So
Yeah.
it looks like we're there. Yeah. Let's see. Let me try recording again. There we go. Okay. Hey, good morning, everybody. At long last, this is Ken, Chris, and Phil. Ken from Tortoise Capital, and Chris from Edgerater, and Phil is in the land in between from Ableway Tech. Helped us make the connection. What a great idea that has turned out to be. To be honest, saved you so much time. I can't even express my thanks for that. I'm still as busy as ever. It's just I'm doing more things now because you've made it a lot more efficient for me to be busy. Um, so what I do today is answer some questions that came in from the team on my use of Edgerater, and also some background logic and beliefs about the systems themselves, because I think the Edgerater folks understand how that program works pretty well. And this is a chance to answer some questions about the underlying logic of the systems and signals themselves. So before I get launched off here into space, let me ask Chris if he's got any open remarks, anything he needs to put out before we get going, and then over to Phil afterwards. Over.
Yeah, okay, thank you, Ken. No, I just wanted to say, so everyone in here, I recognize a lot of people already. So um, the templates that we worked on, they've now been in the program for it's been over a year, and in that time we've had lots of opportunity to run those scans. Phil from AbleWay has been doing back testing on a lot of those signals as well. So he has some great information in his group, the OBUG group. But the thing about the templates, obviously, is you can run a scan and you can see the columns of information, but you don't have the extra things you need in order to trade those symbols. And so, Ken is the guy to talk to and ask questions of about, what when you run a scan, what do you look for? A lot of things might turn up at the same time. So, what do you do in those cases? And then how do you just generally, what's your philosophy around it? we have had a session before, probably a year ago when
Yep.
Ken did a presentation, but now we're another year on and things have developed a bit and settled down a bit. And so, so I'm looking forward to this opportunity now for people to ask questions and really get to grips with these templates. So looking forward to it.
All righty. Phil, any opening remarks?
Well, welcome everyone to this session. I think it's going to be a very informative session. I think Ken will be able to articulate the motivation for several of the strategies and rules behind the template. So I think you'll enjoy this session. Thanks for attending.
Yeah, so no pressure on me. Thanks. Appreciate you. All righty. Let's see. Let me get my annotator going here. If I couldn't draw on the screen, I would be helpless. All righty. All right. So again, I'm Ken Long at tortoisecapital.net is sort of the homepage central for all things for the tortoise. That'd be me. I am a big believer in this little module right here: plan, prepare, execute, assess. That's been my professional mantra as an Army officer and combat veteran and a trader for 46 years. And it gets better each time. So I have learned that the most important phase is prepare. What I found is that you just need enough of a plan to have things to prepare. The preparation then allows you to do very well in the execute phase. Now, execute phase is where you're going to get your results. And so we got to exercise risk management there. The risk management in your execution plan is more important than the plan. And so much of what happens in preparation is really in risk management and understanding all of the contingencies, things that can happen during execution. I want to do a lot of thinking in preparation. I want to do no thinking in execution. I want to be rules-based and battle drill and always leaning towards reducing risk whenever I can. When we're able to survive, then the assessment is the next most important phase, because from the assessment, we can come back and study how we executed, how we prepared, and anything that we might need to adjust on the plan. So that overall top level process has been absolutely indispensable in my military career and in my trading career. The beauty of Edgerater to me is how just amazing and outstanding and excellent it is in preparing the things that our simple plans find. So I want to find things that are excellent for trading, and then I'm going to prepare them. Now, the other thing that I've learned in 40 years of teaching this stuff is that if there's 50 people in the room listening to one system, they're going to end up trading that 50 different ways inevitably. And so most of what we do in the coaching and in rehearsal and in individual training is learning how to adapt a well-prepared plan to your particular circumstances. And so I'm going to address a little bit of that and some of the ways to start thinking about these systems. But the power of Edgerater and the things I'm going to talk about today are designed to put you into the neighborhood of a really good trading opportunity. And we're going to look at two specific timeframes. We're going to look at intraday trading, in which I am taking no overnight risk. And we're going to take a look at swing trading, in which I believe we have an advantage for the next 5 to 10 days of an abnormally large move in our direction, that we're going to find mechanical patterns that historically have given us larger returns in shorter periods of time than the average move. So in one sense, swing trading is trying to find special conditions, or what I call critical states. Typically, the swing trading patterns are designed to go in a particular direction. So if I'm gonna do the channeling system, I first have to see a nice, long, strong move that's greater than the 200-day moving average. So there's this upward momentum that's already baked into the cake. And then the channeling system is looking for pullbacks of some measured distance, which creates an opportunity to buy on dips. Get my cursor working here. So this little pullback is going to give us an opportunity to find a strong symbol that now has a chance to recover to get back to its previous fair value. Now, if you were a person that bought this symbol on the way up, whatever the maximum price was, you think that's the fair value of that symbol, the highest it's ever been. You think that's an obvious fair symbol. So any pullback initially is seen as an opportunity to buy quality on sale. And so when it returns to that previous fair value, what we've done is we got a chance to buy excellence on a temporary pullback, and then we think that that thing is going to continue to go. So we can think of that trade as happening in two phases. One is the return to the previous fair value, and then two, the second phase is when it continues that previous upward trend and everything is back to normal. So there's a certain logic in that particular pattern. So that when we look at the swing trading templates, what you're going to look at is specific patterns that we found over time that have reliably given us positive gains, better than average market returns, but typically in a particular direction. There's a logic to it. We're going to show you a couple patterns that, like the 5-day down pattern, which is simply 5 lower closes in a row. When that happens, that has historically been an overreaction or abnormally fear-driven selling. And now that creates an opportunity, if it breaks out of the last day's range, that if it breaks out of this and starts reversing, then we can estimate the previous peak or the 10-day high as the logical return to fair value. But we also know that there was some reason why this thing has all of a sudden been selling off for 5 days. We don't know what that reason is, don't need to know it. So once we've framed this trade around the 5th day of selling, now what we have is a directional neutral bias. If it goes above that last day's high, then we're ready to go long and follow price back to fair value. If it fails out of that frame, then whatever the reason was that it was selling, well, there's probably more of that coming. So the 5-day down pattern happens to be a pattern that is bidirectional. It has no directional bias, but it is willing to follow price in either direction. So when we get to the swing trade patterns, what I'm going to do is walk you through a summary of the 6 patterns that are on the template and describe the underlying logic so you can see what it is supposed to do if it behaves according to the historical norm. And what we do is we put a stop order in there, a stop loss or an initial risk, which gives it enough room to move in that theoretical direction. But if it doesn't go in that direction and it goes through our stop, then we have enough evidence to say that this time the historical pattern is not following through and we're out of the trade because the logic is broken. We qualify that trade using Edgerater in terms of reward and risk. We're going to measure the amount of risk that we have to take to give it room to work. And we compare that to the reasonable return if it returns to fair value. That has to be at least 2 to 1, or otherwise I don't need to take that risk. I'm trying too hard. So when we have a set of symbols that are in our stack of standard tradable patterns, one of the things that we can do is see a pattern that fires, yes, and then we can qualify them in terms of desirability based on the reward to risk ratio. I'll show you how we do that. So sometimes we have too many symbols, and then we can pick and choose among the best on the basis of some additional information. So that's what I want to say about swing trading, is that we are primarily looking for a moment of opportunity based on historical patterns to get an advantageous move in a period of time that typically lasts 5 to 10 days. When we're looking at day trading, we're looking for symbols that yesterday closed in a compound critical state. So what do I mean by a compound critical state? What I mean is that we have reasons to believe that based on how it behaved yesterday, and we're going to use that as the range, that was yesterday's range. We're going to take a look at location, and we're going to take a look at volatility. And we want to have 2 different reasons why this thing is poised to make a larger than normal move. So it's going to make a large move, and it could go in either direction with almost equal probability. And we would expect that trade to happen fast, that instead of taking 5 to 10 days, we think that this thing is likely to make its move immediately because of the condition that it found itself in. So a compound critical state means that there was a set of anomalies that happened that resulted in this being in a special condition. It's almost radioactive and ready to explode. And there's a strong argument why it could go up and an equally strong argument about why it could go down. And we use location and volatility to inform that decision. And if we have a whole great big stack of symbols, what we can do is we can find things that are at the extremes. Maybe this was a powerful move to the upside that was abnormal, and it resulted in a price box up here. And now a continuation of that exceptional move to the upside wouldn't be surprising. And a reversal back to long-term normal wouldn't be surprising. The fact that it was so abnormal means that there's a strong reason to believe in either direction. And that strength of belief is going to bring emotions, and it's going to bring money, and that's going to add volatility to this move. So when it does happen, when it breaks out of that little compound critical state, we have a reasonable expectation that tomorrow, or the live trading day today, that there's going to be a big follow-through move, that when it starts, it's going to attract momentum in that direction, and we're likely to get an explosive intraday move simply because its starting position was in a compound critical state. And because this is in an excitable state, if I can say it that way, you have strong beliefs on both sides of the trade. So a large move in either direction is not surprising. What we don't know is how passionately each one of those sides of the trade are. We can't see that. We don't know how much money they have to put into this, but what we know is that this is a start position that you would not be surprised if it had exploded. So when we look at our stack of symbols, we want things that are extremely volatile, because that's something that's already in play. It's in play already. It's moving. But we also are interested in things that are extremely quiet. They're so far out of play that it's an absolutely still, quiet body of water. And as soon as somebody throws a stone in there, the sound of that's going to be exaggerated and catch people by surprise. And that may actually trigger a stampede of a herd that was sleeping. So in terms of volatility, we are interested in the abnormal volatility, things that are already abnormally volatile over the last 5 days, and things that are abnormally quiet over the last 5 days. That abnormality is measured against their own historical behavior. So Edgerater helps us classify the relative volatility of all the symbols that we're interested in to find these moments of exceptional volatility that can lead to huge payoffs. Now, the second thing that we're interested in is location. And what we're going to do is we're going to take a look at 3 different time frames. And those 3 time frames represent demographics. And a demographic is a group of people that look at the market in a certain way. And so the demographics that I use are a 150-day look back to represent the long-term position holders and what they consider to be abnormal locations. So if you're near the top or the bottom of the 150-day range, then all of those guys are now in an excitable state because they think something's going to happen. It's either going to break out or it's going to find support and resistance and begin to revert to the mean. But it's in an exceptional condition based on their view, represented by the 150-day look back. The next time frame I look at is the 30-day look back. These tend to be longer term position traders or longer term swing traders. And when you get to the 30-day window, that's had 6 weeks of an exceptional move either to the top or to the bottom of that 30-day range. And they're in a slightly higher agitated state because they're expecting something to happen as they approach significant support and resistance. Same logic, only a different time frame. You know, the 150-day guys may be looking at weekly charts, and the 30-day guys are probably looking at daily charts. And so they're not even aware of what the other person in those other demographics is considering exceptional information. So they don't know that that demographic is in a higher state of readiness to trade. Similarly, for my short-term looks, I'm looking at the 10-day range. And I consider these guys to be short-term swing traders or even intraday traders who are looking for extremes of movement to trigger the compound critical states that I referred to before. Now, here's what happens. If 2 of these 3, or better, if all 3 of these look back periods are in an abnormal location, all of these guys are now suddenly ready to trade. And when support and resistance is violated, suddenly you have an enormous amount of money that comes into the market for trading, and it catches them all by surprise. They were expecting a move, but they weren't expecting that much of a move or that much volume. And so the fact that you've got multiple independent timeframes that can be triggered based on location, plus the fact that it's in a triggerable state because of volatility, you've now created the conditions in which a compound critical state is likely to create an explosive move. So we're using Edgerater to use that combination of insights of multiple time frames, trade location, and relative trade volatility to give us a unique insight into which symbols in our watch list are ideally positioned to make the kind of surprise move that we can exploit with intraday trading. Because we've got to see a move that happens in 30 minutes, 90 minutes, 2 hours in order to be able to trade that with enough size to make a living at doing that. The beauty of the day trading time frame is that we can frame those trades ahead of time and be prepared for large moves, but carry no overnight risk and avoid some of the pain and suffering that's associated with swing trading. So in one sense, you could make a decision on being primarily a swing trader or a day trader. And each one of those time frames is tradable on its own merits. Like you could be exclusively a swing trader and make a living. You could exclusively be a day trader and make a living. I'm going to go out another time frame and think about position trading because somebody asked me a question on that. This is typically guys that are looking for long-term buy and hold or asset allocation and rebalancing kinds of systems. And these are guys that want to hold for weeks and months and quarters and years at a time. In our trading ecosystem, we call that position trading. And we have a number of strategies that we use to be able to follow long-term relative strength. You'll see in the Edgerater templates the work of Bill Scheit. Bill Scheit's been a student of mine for 20 years. He traded the blended monthly rebalancing and the asset allocation systems for his family and his retirement account for 15 years. And he was so good at it that in our coaching, I said, Bill, why don't you just teach that so that I don't have to? And then you can teach other people the refinements that you've made, because we started with a basic set of rules that would adjust on a monthly basis. And then over the 15 years that Bill and I have done coaching together, we found different ways in which we can modify that based on your desires to be adaptive, to include weekly, monthly, conditions-based, leverage, adjusting the look back periods, adjusting the portfolio candidates. And so his template and his teachings show a lot of very reliable ways in which we can handle that long-term position trading. I'm not going to cover those today, other than to say that this is based on the very first kind of trading that I ever did, starting 40 plus years ago, and working with Van Tharp. I was an active duty Army officer, and I had limited time to be able to do what I wanted to do. So I spent most of my time doing that position trading. As time became available and I learned how to do these adjustments, that moved me into swing trading probably 25 years ago. And then I was developing rules-based systems, which you'll see in the templates, and then some adaptive systems that allowed me to use my discretion. The use of that discretion over time allowed me to develop principles that made me an effective day trader. And so 40 years ago, if I were to show my asset allocation between position, swing, and day trading, 40 years ago, I was 100% position trading. 25 years ago, I became about maybe 80-20, and then 70-30 as I became more confident in my swing trading, and then probably 50-30 and 20 as I began to bring some of the swing trading ideas into day trading. And then fast forward to where I am now, I'm about 20% of my total portfolio in position trading, about 40% in swing trading, and about 40% on intraday trading. Now, because of market conditions, and if I may say it this way without offending anybody, the orange-skinned orangutan and his tribe of baboons running our U.S. government, my asset allocation to swing trading systems right now is zero. I am 0% exposed overnight on swing trade patterns. I'm using that money to get double-sized positions on my intraday trading and carry no overnight risk. And the reason is because the amount of intraday volatility has increased, and that's what an intraday trader needs. So what I'm doing is explicitly reducing my swing trading to zero, using that money in my day trading in order to take that advantage of that. If I make good money in the day trading, I am using the excess profits on a percentage basis to bump up my long-term position trading, because those are systems that have stop losses that are outside of the volatility created by the Trump administration. And so I can carry over some of the profits out of this engine of day trading and just maintain my position trading. If and when market conditions change and swing trading becomes viable, in my opinion, then I will start moving that money out of the day trading and back over into swing trading. I've actually begun doing that this week. And the way I do that is I wait until I see an advantageous intraday trade, and then decide to keep 10% of that position overnight as a swing trade, but with a 10 times wider stop and 10 times smaller position size. So I am slowly incrementing back into swing trading using markets money that have come out of the day trading. So there is a way that you can use Edgerater to help you determine the market conditions that allow you to make this kind of asset allocation decision in between position trading, swing trading, and day trading. A lot of the work that Phil and Griff are doing has to do with that kind of research to determine when is it appropriate to go back to swing trading, when is it appropriate to do position trading, and so forth. Now, the next level of integration that I would say is I just described an ecosystem of trading in which, let me get my cursor back. Yeah. So I've just described an ecosystem in which you can do position trading by its own logic, swing trading, and by day trading. We have a concept for execution called core and turbo, in which we are able to blend the insights and signals that come from position trading and swing trading, and it goes in both directions. One of my favorite candidates for swing trading is a target that is already in our portfolio as a position trade because it has long-term relative strength advantage. Anytime I see something that's in my core or blended monthly rebalancing portfolio, and it is in a position where it's advantageous for a swing trade, then I add a turbo position. And now what I can do is manage a single symbol, but have it informed by information from both position and swing trading. That's a very time efficient and information efficient way to manage a complex portfolio. I can simplify my life by having a deep understanding of my primary trading symbols. So when I take a look at my portfolio construction, instead of looking at 10,000 symbols every day, I can take a subset of that, and then I can do some of that with position and swing and day trading. And now I can concentrate on a representative sample of the market opportunity. So I'm going to look for some tech symbols and tech ETFs. I can look at finance and energy and globals and domestic. And as long as I have enough volatility and liquidity and location, I can get all the symbols that I need off a reduced symbol set, and I can develop expertise in these non-correlated or least correlated assets, and I can compete against industrial strength money managers by focusing my attention on areas of interest and expertise. Well, sometimes a good swing trade just keeps going. Like it does its 5 to 10 days of outperformance, but it doesn't stop. And then that could end up becoming a position trade, because as the swing trade gets better and better, its relative strength will improve, and now maybe it qualifies as a core or a BMR. So I'm never surprised when a good long-term swing ends up becoming a position trading, and that's actually a way that you can get into those good long-term positions at a moment of advantage by starting it as a swing trade, and then it simply grows into a position trade. That's a really nice situation. My positions in Palantir, NVIDIA, Tesla, all started off as opportunity trades for swing trading, and it just kept going. And then with markets money, I could grow that into a position trade with reduced risk. Now, similarly, I can have things that are already relatively strong, and then I can find opportunities to trade them as swing trades and even as day trades. So this is a bi-directional relationship between position trading and swing trading. So we call that synergy core and turbo trading. Now, In the same way, there is a relationship between swing trading and day trading. It turns out that if you had a good swing trade pattern, like a 5-day down, try to draw that 5 days down. And if this thing was compressed into a doji, you now have essentially a compound critical state created out of a good swing trade pattern, because the fact that it has had abnormal selling and it has reduced volatility, you actually wouldn't be surprised if it broke out to the upside or broke out to the downside. And because the size of the doji is small, the amount of initial risk that you have to take is small, and that would allow you to build a standard reward to risk ratio that might be 3 or 4 to 1 in either direction. And then all you have to do is wait to see which way it goes tomorrow and which of your mechanical entry signals are hit. Well, that would be good. That would be a good one-day trade. That would be a turbo trade intraday on a swing pattern that we would expect to actually see 5 days. If that swing trade from 5 days down works like it historically does, we could have a directional move that lasts 1, 2, 3, 4, 5 days. Well, what if on day one you got a nice pile of money because it had a surprise breakout and it closed well? Hey, what if the next day that thing just keeps going? All it's doing is behaving like a swing trade pattern. And so as long as it's going up, you can re-enter your turbo position the next day. You can take off the position so you have no extra overnight risk. But if it continues to go up and the swing trade is still open, you can add the turbo back on as long as it's going up and it never hits the stop loss of the swing trade. So I can now use swing trading patterns as information to give me opportunities to trade high price, high value day trades. So when I'm thinking about day trading, I end up having 3 different categories of candidate symbols. The first one is, if I had a swing trade that is still open and yesterday I made money on it, I'm always ready for that to be a swing trade tomorrow. So all I have to do is update my preparation for a symbol that I'm already emotionally and conceptually tuned into. The next one is a new swing. So now suddenly, if today's price action in Alcoa created a new 5-day down pattern, well, I didn't trade it yesterday because it wasn't in play. But today it's a new swing symbol for 5-day down. I can now decide to trade that intraday using intraday techniques. And if it really pays off, I can then turn that into a swing trade and use swing trade position sizing and rules to manage the rest of the day and the rest of the trade. But I was able to use day trading techniques to make money that would fund the overnight risk of a swing trade. So that's a case where a new swing pattern could actually be a really good candidate for day trading. And then I have what I would call my old reliables. And these are symbols whose intraday liquidity and volatility make them reliable intraday candidates no matter what happened yesterday. And these typically are things like large international indexes that are liquid and volatile enough to allow a small retail trader like myself to take advantage of large, typical daily market moves. It could also be something like Palantir, NVIDIA, Tesla, the marijuana ETF, Australia, Canada, and Mexico. These are all symbols that have enough volatility and enough liquidity that using our rules, we can find a good trade intraday on just about any day. Now, I would prefer to trade those if they also had a swing trade pattern, or if I had made a lot of money on them the day before and they're still in play. But those are the 3 candidates that I use. and I use Edgerater to help me find those become good candidates for day trades. Now, if it turns out that the day trade today was so good, it might actually become a swing trade. And if that swing trade continued to be good, you could end up seeing that thing becoming part of your position trading. In my long-term core portfolio, I have positions in Tesla, NVIDIA, and Palantir that have been completely funded by markets money. No original seed capital of mine was involved in the purchase of those positions. That's as if you're walking down the street and somebody says, here are 10 free shares of Palantir. Do you want them? And then you would say, yes, I do. And then even if that symbol goes to zero, you're not out any money on your core capital. That allows you to withstand some of the shorter term volatility because you have a wide enough stop loss. Maybe it's 50%, maybe it's 100%. But you can have an appropriate stop loss that allows you to weather the storm of shorter term volatility. So in that sense, what I've now just described by using all three of these and using core and turbo is that I can actually think of my portfolio now as a meta system in which I have an appropriate amount of portfolio exposure to position trading, swing trading, and day trading as driven by my preparation, supported by Edgerater's mathematics. So I think of my position in an integrated way over different periods of time. When I'm thinking position trading, I'm looking at monthly and weekly charts and then tactically at daily charts. When I'm looking at day trading, I'm looking at 1 minute to 15-minute charts. When I'm looking at swing trading, I'm looking at weekly and daily. When I'm doing core and turbo trading between swing and day, I use the 2-hour, 1 hour, and 30-minute charts to help refine my understanding. It's a little faster than routine swing trading, but it's slower and more deliberate than pure intraday. Similarly, if I'm doing core and turbo between position trading and swing trading, I can use weekly, daily, and 2-hour charts in order to get a refined understanding of the patterns that I use. Now, this is going to get to the questions you guys had about the difference between prep and execution. What I'm using Edgerater for is the prep. And I'm understanding what I should be trading and how it could be traded based on all my preparation. So Edgerater, for me, lays out all the contingency patterns. It could be, here's something that's in a compound critical state. If it breaks out of that range, the maximum reasonable intraday move would be that far in either direction. If it's a swing trade over the next 3 to 5 days, it could go this far to the upside. And now what I have is a boundary of reasonable expectations and potentials if the price decides to go in that direction. What I have to have is a way to execute, and that's where our systems rules and the indicators that we use tell us when is it time to get in, and then how do we manage that trade as long as it's going in that direction. And that's getting into the execution phase. Now, Edgerater is how we do the prep. Your trading platform is going to help you with the execution decisions. But what I like to, what I enjoy, the gratitude that I have for Edgerater is that everything that I'm executing on is coming from a place where my preparation tells me that I can quickly get to a no lose plus dinner for two position once price starts to break out of the preparation box, if I can say it that way. And that's true whether I'm doing intraday or swing trading. Now, it is beyond the boundaries of what we can do in this session here to talk about the execution phase. In fact, my entire teaching and coaching practice is how to do those things. My commitment to the Edgerater community is to give you the lowest possible cost of entry to learn how to do those things. I will tell you that the best way to do that is to work with Griff and Phil, because what they have done is taken my foundational trading courses and built out simple rules-based systems that allow you to do the prep and then allow you to trade what we call the Kata 2 pattern and allow you to trade intraday and turn those intraday signals into swing patterns. Whatever price you feel is comfortable that you need for learning how to do these things, I'm willing to underwrite that if you're willing to put in the sweat equity. We have a price, but I'll give you your money back if you're not satisfied after whatever period of time you need. I'm just going to make that an open-ended commitment to the Edgerater community because I'm 68 years old and I don't have time to monkey around. I want you to learn these things in the lowest risk possible way. I've got 1,000 students, most of them long-term students. There's about $10 billion of professional money management money following these rules. I know they work, and we can teach you how to do it if you have the right alignment with the kinds of beliefs that it takes to trade the patterns that we have. I want people to be successful. I want these systems to be in place and to live after me when I'm gone. Thus, Phil and Griff are the way to get into that technique. We'll underwrite the cost of learning that stuff. They're pulling their hair out right now and hearing me saying that. Well, Phil and Griff, you can waive my portion of that course as a benefit, but you're not going to get better trading education, in my opinion, than what you're going to get from Phil and Griff when it comes to the basics of blocking and tackling, of implementing our strategies. Edgerater is already giving you an unfair advantage. When you use our templates, you're going to find things that move, and you'll probably be able to trade them in the way that you are accustomed to trading because they give you things that are starting to make large directional moves. And that's what your signals and patterns are designed to do anyway. So if you just started with our patterns and our findings, you could probably trade them in the way you like to trade and have an unfair advantage from the get-go. If you add to it the education that Phil and Griff and I can provide you, you probably can take even more advantage out of doing those things. And we're happy to help you. All right, that's everything that I wanted to say about that particular slide as background before I get into specifics on Edgerater. I want to pause there for any questions that you might have before we get into the meat and potatoes. That was the simple introduction. Sorry about that. Sometimes that's how it happens. Let me take a look at the chat window here real quick. Yeah. Yeah. Bill's had a question on quality trade. So let me jump into that. The first thing I want to say, Tom Hamilton had a specific question. What are my thoughts on an effective ETF rotation strategy, momentum, and timeframes? I sort of hinted at that already. This would be my non-handwritten and therefore legible response. That's the first way I became trading as a trader about 40 years ago. Was I was doing mutual fund switching on a weekly basis according to some rules. That became an ETF-based switching once ETFs became viable and mutual fund switching became unfeasible. The ETF switching ended up becoming pattern swing trading. The pattern swing trading ended up becoming intraday trading. And what I can say in general is that rotational trading works. It requires patience and discipline because you have to sit on your hands when it's time to do nothing, and you have to have the discipline to follow the rules at turning points in the market. And that is excruciating. Let me tell you, I've lived through 4 different market explosions where the market has lost more than 50% of its value in less than a month. Getting out of a bull market when it starts to collapse is hard, but it's not harder than getting back into the market after a bear market explosion. Most people stay too long in the bull, and then they wait too long to get back in after the bear is gone. And that's why it's excruciating at the transition points, because you are acting differently than the rest of the herd that surrounds you. So transition states are excruciating, which is why you must have patience and discipline. The one thing that stays with me the longest out of all the work I've ever done in this area is why the 5-week rate of return is important. 5-week rate of return, if you do nothing, just make sure that whatever you're buying for your long-term portfolio is up over the last 5 weeks, and you'll never regret that decision. What's that mean? Well, it means that you had to see 5 weeks, the net return of which was positive. 5-day weeks, and it's higher than it was 25 days ago. Okay, I'm in. Am I all in? Well, maybe not. Maybe I got rules that allow me to increment. That's what the refinements in the blended monthly rebalancing that Bill Scheidt now teaches will do for you, is figure out how to sensibly get in and how to sensibly get out. But the central idea here is that 5-week rate of return for me has to be positive before I have any reason to believe that the market has recovered. Now, here's how I know that. I've studied the last 50 years of the market. I've taken a look at every 40-day holding period in the market. And what I've found is that the worst 40-day period in the market was down about 39%. The worst 20-day period in the market was down about 35%. What that means is that most of the pain and suffering happened in 20 days. That bad 40-day period included an absolutely miserable 20-day period. The worst 10-day period is about 30%. And that means that most of the pain and suffering that you experience in market explosions occur between 10 and 20 days of absolute misery. After that period, everybody is still bruised emotionally, but the failure to fail further is an indication that you just might be in a transition period. And after 5 weeks, where that thing has bottomed out and is now positive over the last 5 weeks, which is essentially the last 30 calendar days, you have reasons to believe that the pain and suffering is over and that this might be an opportunity to buy quality on sale. In the COVID melt-off, the market was down about 50% in 20 days. And then it made a 75% recovery to get back to previous highs. So that's why I say the transition states are excruciating, and you must have patience and discipline to manage that kind of rule-based system. Bill Scheidt's array of teaching courses is a collection of all my best ideas as refined by he and I together over 15 years of coaching on a weekly and a monthly basis. He's got variations that allow you to do weekly adjustments, monthly adjustments, quarterly adjustments, conditions-based adjustments that if you see a move of this size, that you can do almost like a contingency order. It takes into account market classifications. It allows you to consider adjusting the symbols that are contained in your portfolio to make your adjustments. He's got the definitive package of learning when it comes to ETF rotation strategies. The final thing that I will tell you is this, that correlations and the dynamics of correlation change during extreme market conditions. Most conventional, traditional asset allocation models are based on very long-term net results, and they demonstrate least correlated targets when they're building their little portfolio. They're getting diversification by studying uncorrelated assets over long periods of time. Here's where those correlation models break down at moments of extreme disaster. That when you are in the middle of a major market meltdown, all of the things that used to be least correlated have suddenly become correlated. They were least correlated because most of the time people were switching between asset classes. During market explosions, everything goes down together and money is leaving the market. And so what used to be least correlated, you thought you had safety because you were uncorrelated. Suddenly they're all going down together. And then when you need that insurance the most, you don't have it. And recovering from those kinds of disastrous events, of which there have been 4 in the last 20 years where you lost more than 50%, and it took multiple years to recover that. Hey, when I was 20, I could eat that. I'm 68. I can't eat that kind of a loss. And so, depending where you are in your life cycle and what your investment time horizon is, hey, if you're 68 years old and you are trading the 200-year portfolio of your family estate, you can take risks that are different than if you're 68 years old and you're only trading your own retirement account. So your time horizon and your risk tolerance and your skill with patience and discipline is the most important part of answering this question about what do I consider to be an effective ETF rotation strategy? Should it be momentum based or inverse momentum based? And which time frames to evaluate? Edgerater has all of the computational power that you need to study the variations, to backtest the different systems and strategies, and come to a personalized, risk-informed decision on how to answer this question for yourself. That's extremely important. That may be the most important thing that I say today. And typically it is. I'm usually not smarter than that. But that's what I want to say about the effective ETF rotation strategy. Although it sounds simple, it is not. It gets to the core of who you are as an investor, as a trader, and it makes you do your due diligence. So that's what I want to say about that. Questions before I move along? Here we go. Understanding the template structure. The question was, what's the logic and structure behind each of the key templates? I will cover those in a minute. When I do that, I'm actually going to be able to answer some of these other intermediate questions, like how do I interpret the signals? Which ones are most important? How to clarify risk reward? What does the auto framer mean? I'll do that. I will distinguish between the intraday swing and longer term trading when we get there. On the performance and filtering, this is what I want to say. I design my systems so that the filters and preconditions that are necessary for action are built in as rules. So if I have a swing trade that only works in bull markets, what I do is include the filter or the precondition of price must be better than the 200-day moving average, if that's the rule that I'm using to define a bull market. So I build the filters and signals in so that they must fire in order for the ultimate signal to fire. So I don't believe in doing incremental analysis like, hey, this signal fired. Oh, let me go check it with the market to see if it's still really good. Oh, no, it isn't. That's too much thinking. So I believe that in effective design, you want all of those logic gates in the rule sets themselves so that when you get all green, you can now act on it with a standard frame. I don't believe in doing multiple iterations. Now, what I do believe in terms of filtering would be something like, hey, I've got 30 good compound critical states, but I only want to trade the 4 or 5 best of them because of my span of control. Now, how do I sort those in terms of desirability? They're all tradable. And now my decision is I could frame all 30 of them and then take the first 5 that fire, or I could do what I think is better, take the best 5 based on reward to risk ratio and only trade them when they fire and trade them in a massive way. That to me is the personal method of adopting to the problem of, you get too many good signals. First of all, that's a good problem to have. Second, I need a way that feels professional to me. so that I don't second guess myself. Because what'll happen is that one of the things that you screened out ends up being the biggest winner of the day, and your filter made you not use it. And maybe one of the 5 that you did choose didn't act at all. And then you have, in retrospect, with perfect hindsight, you say, oh, I should have added that other one. And then you start second guessing your own strategy. So one of the things that you need out of patience and discipline is the ironclad belief in your process and an assessment adaptation strategy that allows you to study the results and decide when your filtering needs to adjust on the basis of a data set and not on the basis of a knee-jerk one-day regret action. Like, I don't want an emotional response to make me change my rule set. I want my rule sets based on a statistically significant set of data, and it takes a significant set of data to make me choose a difference in my rule set. That's what we do in our coaching program. I'm going to tell you right now, the single best thing that you can do for coaching is, in my opinion, hear me now, believe me later. Our coaching program right now just added a new thing this week. In my alternate life, I'm responsible for a significant portion of the U.S. Army's AI strategy for leader development. I work with the 3-star general who's in charge of all Army schools, and we are presenting our strategy to develop leaders with artificial intelligence. He's briefing that to the senior generals of the Army this week. As a result of that, for the last 18 months, I have been using Google Notebook LM, to create a number of individual second brains. In my trading second brain, I've created a Google Notebook that has 125 million words of highest quality research insights. Those 125 million words are the sum of every briefing on trading I've ever given in any workshop over the last 40 years, plus the 1,500 hours of individual and small group coaching I've done with my clients, individual and professional, over the last 15 years. Every single research project that we've done in our weekend research annual conferences over the last 15 years, all of the lessons learned from the nightly podcasts that I do for the last 15 years, everything I've ever written, researched, collaborated, and studied on, equals 125 million words. All of that is in a single Google Notebook. This week, Google, praise be their name, allows me to share my Google Notebook with others. I can put a filter on it so people can't monkey around with the underlying references, but it essentially gives you unlimited Q&A of that data set. It answers those questions the way I would answer them on my best possible day, with no loss of memory, as seasoned by all of the collaborations that have come out of our community of practice. Like all the coaching that I've done with my mentors, it's in there. It is astonishing. I don't answer any questions anymore without me actually referring to that, just to make sure that I haven't forgotten anything. Now, because I can do that, I've added that as a capability to our annual coaching program. That annual coaching program has 2 flavors. Flavor 1 is a active small group coaching program that I charge $3,000 for a year of weekly coaching, where we have structured application of learning to your personal system, and we coach you through your adaptation of our systems. You should only do that after you have a good enough understanding of our systems that you're looking to finalize it and fine-tune it and do that. I will only charge you that for 1 year. After you do that for 1 year, I have beaten you up enough that it's maintenance at $1,000 a year after that for as long as you want it. But you always get lifetime access to all the coaching files in that program. So that's what the active coaching for 1 year constitutes. I'm leaving a lot of money on the table by doing it that way. The second version is what we call the over-the-shoulder passive coaching, What I give you in that for $1,000 a year is access to every coaching session that I've ever done with any of my active clients. And that goes back, that's where there's over 1,500 hours of personalized one-on-one and small group coaching. You have access to all of that. I would recommend, if you wanted to undertake this in a serious way, what you should do is take Phil and Griff's course on Kata 2 and advanced system design and participate in their OBUG community of practice, because you're going to learn a tradable system. You're going to learn how to develop a tradable system week to week. You're going to see how to use Edgerater to trade and prep for that system. And you're going to get a chance to do the coaching in small group with Phil and Griff and the other Edgerators who are using that system. When you're ready for it, if you even need it, then I would suggest you could try the passive over-the-shoulder coaching to see what that's like. There's enough of those sessions that are out there for free. You'll be able to tell if it's going to be helpful or not. If you want the advanced personalized coaching, which is what I do usually with the professional money managers, then you could take the more advanced coaching if you wanted to. I'm adding that Google notebook access to both of those coaching programs. And that's at $1,000 a year for passive. And I actually think it's worth it just to be able to do AI question and answer to that brain. And here's the other thing I'll tell you. If you were a passive over-the-shoulder coacher and you had a question and you send it to me, I'm going to answer it. Because that means that you had a question that my Google brain couldn't answer. I need to know those things so that I can craft that answer and put that into the Google brain. So you're doing me a favor if you send me a question. That's why I'll answer your question, even if you're doing passive over-the-shoulder coaching, because I want that Google brain to be as excellent as it can be. And the way I make it better is when you give me questions that I've never answered before. So I challenge you to send me a question I haven't answered before. I hope you win. So that's what I want to say on that. That's the best deal going. I can't believe I'm doing it that cheap. That's don't tell my wife. She'd shoot me in the face. All right. The reason I say that is because that AI breakthrough with Google happened this week. Our strategy happened this week. Let me tell you who I'm working with on that strategy. 2 weeks ago, the Army just did a direct commissioning of 4 technology officers from AI companies, and they made them lieutenant colonels in the United States Army Reserve. I'm working with those 4 guys to develop leadership strategies to teach the Army how to use AI. The first guy that they hired is the chief technology officer of Palantir. The other 3 are as smart as him, and they're coming from OpenAI, and then the guys who do Claude, and a guy from Google. I'm telling you, I mean, I can't tell you how excited I am to work with those guys so I can make Army officers better in the use of AI. We've got an AI home study course already. The guy for traders that guys are happy with. I'm looking forward to how I use AI to partner with Chris White, who should be salivating at the idea of being able to validate. Here's where you're going to win, guys, is validating the bullshit work, pardon my language, validating the hallucinations that come out of AI. You know what you have in Edgerater? A foolproof way to validate any insight that comes out of AI. You know how many people are going to do that in the world? Not very many. You know who's going to have a long-term persistent advantage? People who use Edgerater to independently verify the things that come out of AI models. That's how you're going to win for the next 30 years. You can hear me now and believe me later. Think about that one. That may be more important than the other thing I said about the risk. Nope, it's not. Who you are for the ETF rotation strategies and your risk tolerance, that's still the most important thing I said today. This, what I just said, was the second most important. Now, let's drive on. I want to respect your time. Plus, my daughter's calling me to coordinate the going to the soccer match tonight. So here we go. On the left-hand side, you see intraday critical states. These are designed for intraday trading. These are the sniper trading patterns that I use to find things that are very good for intraday trading. I'm going to cover those as quickly as I can. That's these. We're going to see that template. Over here are the mechanical swing trade patterns. I'm not going to cover them very much because I think they're pretty straightforward. The template that does mechanical swing trade patterns actually is two templates. There's one for ETFs. That's an F, sorry. And then there's one for stocks. But it's the same rule set. It's just two different watch lists. Now, two of them, channeling and overreaction, are designed by rule to only work in bull markets. Oh, here's how we decide what a bull market. It's stronger than its own 200-day moving average by 2%. And if it's a bear pattern, it is more than 2% below its 200-day moving average. That's how we distinguish between bull and bear. A sideways market is when price is within 2% of its 200-day moving average. Now, I typically use that simply on SPY, and then I use the market condition to guide swing trading, and I try to be in the direction of the broad market. It turns out that you can actually use not just SPY, you can take a look at the symbol itself. Like if you were trading treasuries, you could use that market classification for treasuries, bulls, sideways, and bears, and it would be informative. Channeling is the simplest one of all. What it does is it says the symbol is higher than its 200-day moving average, and it has temporarily moved down to 10-day oversold. So that is a gentle decline, and now you're buying on dips, and you're going to just buy dips until the end of time. That's channeling. It's about a 70% reliable signal over the last 30 years, year in and year out. So both of these are about 0.7 reliability on aggregate. Some years they're 90% accurate. Some years they're 50% accurate. They've been positive payoff for 90% of the years. Overreaction is a pattern that says the 200-day moving average is here. Price is above the 200-day moving average. It is also it looks at the 10-day moving average as a short-term indicator. And if there was a news event that caused it to gap down and all of the price is below the 10-day, but still above the 200-day, now I can buy that tomorrow with an expectation that it's going to return to the 10-day high. So an overreaction is a one-day anomaly where you have a sharp sell-off based on volatility. Any day that you see the overreaction fire, the channeling typically has fired as well, because it drifted below to a 10-day oversold. So some days you will see a symbol that is both channeling and overreaction. That's actually a really good day to trade that tomorrow. There are two ways to trade those. You can just buy them mechanically at the open, or you can use intraday techniques to trade them with some discretion. I have a course that teaches how to do that, and we have rules that teach you how to do that. Those are bread and butter systems for me. The triple screen is my interpretation of Alexander Elder's triple screen system. I've been trading that for 25 years. The 551W system is very similar to the triple screen, but you get more signals because it has more relaxed criteria. I will send you the system definitions if you want them. Happy to do it. All you got to do is ask. The 551W says it's above it's 5-week close. So if you went back 25 days and that was the closing price, today the closing price is better than it was 5 weeks ago. That's good. The second 5 means that 5 days ago the price was here, and now the price has pulled back from where it was 5 days ago. That has now created a buy on dip opportunity. The 1 means that today's price action was an open candle where the close was higher than the open, and that gives us like a 1-day momentum. So you get a pullback, and 1 day of recovery, and then you buy a breakout above yesterday's high. That's a continuation pattern. That looks very much like the triple screen, but it has more opportunities because it is slightly relaxed criteria. I love this thing. The W stands for Williams %R, and what that says is that if you bought the mechanical entry here and used and looked at the 10-day low versus the 10-day high, that you are on in the bottom half of the 10-day range. That means there's enough room for it to simply get back to the 10-day high to qualify as a reward to risk ratio. That's what 551W means. The 5-day down is a pattern that started with research offered by Larry Connors, and we did some additional math on it, and we built a system around the idea that if you had 5 lower closes in a row, that if you took that last day and used this as your unit of risk, and it opens inside yesterday's range and breaks through yesterday's high, that you could buy that using the daily range as your 1R risk, and then you would have a positive 2-to-1 return to risk as on a return to the 10-day high. So you use yesterday's range as a risk, you have a 2-to-1 test to the 10-day high, and it was predicated on the fact that you had 5 days down in a row, which is probably an emotion-based or a fear-based. It's an overreaction created by short-term fearful momentum, and that has created an opportunity to resume. It turns out that when channeling and overreaction both work in the bull, triple screen actually can be used in all markets, as can 551W. The extra goodness of the 5-day down is that once you establish your trade frame, which is to go long above the high of the setup day, you can also go short. Sorry, that should be red. Excuse me. You can also go short if price continues to fail. And the logic was whatever caused this thing to be down 5 days in a row and it's continuing to fail, you can pile on that one. That's actually a better signal than the 5DD long. And especially if you're in a bear market and you see 5 days down in a row and the next day takes out yesterday's low, you better be short that intraday and take no overnight risk. You better just pound that one on a 5DDF. The washout pattern I'm not going to explain because I don't think you need it, but it is a technical pattern that we developed over the years. And what you need to know on that was it was long-term horribly oversold in the last year. And then the last 10 days, it was horribly oversold. But yesterday was the first day of momentum, and we're going to buy a breakout. That you should never believe in that one, but you can trade that one using our rules. What you really want to know is that the failure of that one is one you want to pound. So it turns out that the washout failure, the 5DD failure, is always a good trade, and especially in the bear market. It turns out that what you should do when the price is within 2% of the 200-day moving average is nothing. You should just wait for the market to vote towards bull or towards bear, and don't get chewed up in the chop. That's what you should learn from swing trading. Now, the two templates for mechanical swing trading are based on, one gives you ETF, the other gives you stock symbols, and each of those templates have all of the criteria set up to make these things viable or not. And that's everything I want to say about that till we look at the template. Now, for intraday trading, there are 5 patterns that I look for on the setup day. What I'm looking for is I'm using Edgerater to find these 5 patterns. And if they are ready, I'm going to intraday trade them as soon as they break out of the risk box. How I trade that goes beyond the limits of what I can cover for you today. It is well described in Phil and Griff's work. I will offer you a sniper trading system on how to trade that in detail. Trust me when I say that if you have a symbol that is in a intraday pattern of any of these on Edgerater, don't be surprised tomorrow if that thing takes off like a scalded ape and gives you an amazing trade. If you're an intraday trader at all, you'll be able to trade that. Here's what they look like. We're going to look at the location and the volatility. On fireworks, and what I'm going to say here, this box represents the 150-day look back period. And this box represents the 30-day look back period. What you have in the fireworks pattern in purple is a symbol that is in the upper 10% of the 10-day period and the 150-day period. That thing is exploding with fireworks. It's going to be amazing. One of 2 things is going to happen with that thing. It's either going to continue to blast off or it's going to collapse because of the amazing run that it just had. So what we do is when it's in a fireworks condition yesterday, today we're ready to see the opening, and wherever it is, we put a risk box bracket around that and we trade it in the direction of the day. And if it turns out to be an amazing large range day, we could have 10 or 20 R on that day. That's how we trade all of these intraday patterns. We know that there is a greater than normal likelihood of a larger than normal move in a shorter period of time than normal, which often equates to a 1-day explosive move. And the way we trade them is identical. If it's a fireworks pattern, I find the opening and I put a risk box around it. If it's a fence sitter, I find the opening and put a risk box around it. Both of those are equally likely to have a big move, and the size of that move is large. How you get to it, the psychology of it could be different. So a fireworks is something that moved all the way to the top and closed in the upper 10% of both the 10-day and the 30-day and the 150-day range. Humpty Dumpty usually happens after that. Humpty Dumpty is something that started as a fireworks, but now has closed in the bottom of its 30-day or 10-day range. So you had an enormous move to the top, and then the 30-day range was the great fall. And now you say, Humpty Dumpty. All of the guys that bought him on the way up think that is a buy on dip opportunity, and so they want to buy it. All of the people who saw the pain and suffering say, BS, that just broke. This thing is going to fail further. So you get guys on both sides of that trade ready to go hard with big piles of money. So all I do, I find the opening, put a risk box around it, and I wait to, as soon as I get the breakout, I follow the price. That's what I do. The sniper system puts these guys in a tight box and then shoots them as soon as they leave the box, and I have no directional bias whatsoever. If it turned out to be an amazing 1-day huge move to the downside that earned me 20 R, I might just keep 2 of those R and turn that into an overnight swing trade using market's money. But I don't have to. I can just wait for tomorrow to open and put the turbo position back on. Easy. The next one is the fence sitter. Let me first check chat and see if there's any questions on that. Let's see, where's my old chat box? Yeah. The fence, let me go to the other end. These are the two things that you do when this thing is outrageously good. These are the two things you do when that thing is outrageously bad. I care about the extremes. That's where the extreme results come from. Godzilla means this thing is in the bottom 10% of its 150-day and its 30-day. This thing is horrible. And the volatility is large. Godzilla has just come out of the ocean. He's angry and he's ready to stomp Tokyo. Now, he's either going to run north and stomp Tokyo north, or he's going to run south and stomp Tokyo south. All you know is that it's in an extreme condition by location, and the volatility of Godzilla is ready to stomp. That's the best pattern that there ever was, because it's already in play at the end of an extreme condition, and you're either going to get this enormous buy on dip opportunity, the dead cat bounce, or you're going to get the next collapse to the downside. It's an amazing trade, and it's already in play because the volatility was large. Here's how you get a large 5-day volatility. You could have had a 5-day high here and then 5 days down, and it closed at the bottom. And then the distance from the 5-day high to the 5-day low was larger than most of the previous 5-day ranges. That's a plus volatility. You might also get that by something where you had 4 days of absolute quietude and then one enormous day that sold off and then closed up here. And that one day was so large that the distance from the 5-day high to the 5-day low, which all happened in one day, could make this a plus volatility day. Go look at Palantir. That's what a 1-day explosive move can do to a 5-day volatility. So Godzilla is at the end of a long sell-off and 1 day of extreme volatility. A catfish is at the end of a long-term sell-off and it's quiet. Like it could have been 5 little quiet days in a row. You know what's amazing about 5 quiet days in a row after a long 150-day slide? Hey, how come this thing has stopped failing? All I know is that it has 5 days where it failed to fail further. That might signal a quiet move to the upside. Catfish comes off the bottom to bite, or food came down and the catfish is now going to continue to go deeper, just like it did for the last 150 days. So catfish is not in play, but it is so quiet, it is so abnormally quiet that you can have a small risk box, and then the subsequent move out of the quiet ends up being a high R multiple payoff. That's what happens at the southern end of these trading patterns. Now, let's see, we're going to erase those. That leaves the little fence sitter. This one is really slick. So imagine you had something that this was the 150-day high and that was the 150-day low, and this little guy was sitting right on the 50-yard line. And let's say this was also on the 50-yard line for the 30-day look back. And the volatility was so quiet that you could have a small risk box right in the middle of the crowd. And it turns out the size of that risk box would allow you to have a 3 or 4 to 1 trade in either direction that came from the absolute middle of the crowd. That is such a sneaky trade that there is not another pattern or system out there that looks for anything like sitting in the middle of the chop. But this is actually one that it's like a stealth trade. I've included that because sometimes things that started off as a Godzilla that went up in here, stopped, and then maybe it went all the way up here and then came all the way back and then became quiet. The follow-on recovery or the follow-on failure can often make a fence sitter interesting. You can make a living off of the extreme winners that continue or fail. You can make a living off the ones that were extreme winners, have experienced one significant sell-off, and then are either buy on dips or continue to fail. And you can make a living off things that were extreme sell-offs and gave you one day of amazement. That's Godzilla right there. He's either going to continue to stomp his way north, or that was a dead cat bounce and it's going to fail back to the previous low. I hope it fails back to the previous low, because if it now violates and makes a new low, that's where we add a second position in our collapsing dragon pattern. Those are the critical states and the logic behind them of the compound critical states. These are the ones that I trade intraday. These are the ones that I trade as swing trades. It turns out that there is a fractal relationship that when you look at these patterns and how you trade it, you can actually see those same patterns on a 3-minute chart, a huge sell-off that has started to recover. That our little supported spring crossing, which Griff and Phil teach in the Kata 2 course of how to trade, that's nothing more than a Godzilla pattern on an intraday time frame. And the same logic that we use to trade that on a daily basis, we can now trade that on an intraday basis. And all the little buy on dip opportunities on the way up, those look like channeling patterns. So there is a strong relationship between the logic of these patterns and these setups that gives you a common frame of reference about how to trade. And that's what I mean by the initial planning to trade in a certain way, using Edgerater to prepare the contingencies and to rehearse, and then execute violently with a couple simple standard patterns. Then we use coaching and assessment and statistics to make decisions on how to adjust our rules on the basis of data. You're going to see how to do that in Phil and Griff's course. I've got some material in my publicly available coaching workshop. That's what I do every week with all of my coaching clients. I'm happy to put together a bunch of sample sessions. If you go to tortoisecapital.net, you're going to see many, many examples of how we use statistics to evaluate trading programs. Go to tortoisecapital.net, go down and look at the area where I have student presentations for their annual coaching graduation exercise. Go look at Luke Crockford and Ken Hum. You can actually go take a look at Phil and Griff's graduation ceremonies and their exercises, which is what proved to me that they were ready to be subordinate teachers for me. So go to that website. You can see those files for free, and then you'll know if our style of trading intraday is well suited for you. Even if you don't trade intraday or swing trading the way we trade, you're going to find that the Edgerater preparation, the templates of the symbols that we find, you're going to find some amazing symbols. And if you watch that for 30 days, I think you're going to know pretty quickly if that is the kind of trading that you would like to do. You'll see many, many examples of that stuff. If you go to my site on YouTube, youtube.com, KenLong.Tortoise, there is about 5,000 free to the public trading videos of our case studies and our style. And that should give you a free way to judge whether or not the kind of trading that we do could work for you. And that's all I want to say about that. I do have to get ready to go here pretty soon. My daughter's calling me again about our family date night tonight. And you've been very patient and polite and suffered through this for over 90 minutes so far. And I've given you a lot of stuff to think about. Let me see if I had any other things on here that I needed to cover. I don't think so. Here's what I would say off the original list of questions. What I personally do not use Edgerater for is back testing and optimization. I've done so much of that stuff already with my own trading over the last 40 years that what I needed to do is find me these candidates, and I'm persuaded that I can trade them going forward. So I'm not really trying to over optimize that. However, your mileage may vary. And what you would find is that working with Phil and Griff in the OBUG, which is what does he call that? Phil, what's OBUG?
Yeah.
What is it?
Owl Bundle user
Oh,
group.
the Owl Bundle. So Phil and Griff put together the Owl Bundle, which uses our strategies and Edgerater and whatnot to a set of conditions that really work well. And they do all kinds of Edgerater back testing. It sort of bears out my faith and confidence in the systems. Let me put it this way. I shamefully admit that I use their back testing to validate my beliefs, but I don't do back testing. I let them do it for me, and I trust with the work that they do. And I believe in forward testing with small position sizing, and then I let real results tell me when it's time to increase position sizing. So I used forward traded evidence-based markets money to grow the position from one live share all the way up to where I am now at about $500 of risk per trade. That's covered extensively in our coaching program. And how to do that is actually in the Google Brain application for AI that I taught you about. So I've given you a lot of stuff to think about. Appreciate your time and attention. Our edge comes from building a collaborative community of practice that is based on shared values, evidence, mutual support, and standing together against the challenges of a voracious, relentless market that's going to be increasingly dominated by AI in the future. And that's why I work hard on AI 50 hours a week with the Army, because the Army's counting on me to help them develop bulletproof decision-making with AI under conditions of stress. I'm a combat veteran. I've led infantrymen in combat. I know what stress is. The stress of trading is as stressful as combat. I know that. I'm writing that book on 5 frames for traders with Mark Randall from AlphaMind, because we both believe and we know that trading is like combat, and we're building a program to increase trader resilience and what we call the diamond mind that allows us to endure the stress and the psychological stress and rigors of trading. That's the other part of the component. You got to have a market that works for you. You have to have systems that work in that market, and you've got to have the bulletproof psychology for the patience and discipline to endure the life of an individual trader. It is considerable challenges, but we have ways to deal with it. And I'm trading better than I ever have, and I attribute it to the community of practice that gets reinforced for me every night in our nightly podcast and every night in our coaching sessions. And we share those with you because I think that's important stuff. And we got people counting on us to do that right. That's my interest. That's my skin in the game. I'm better because I teach. Somebody asked me why I teach. I teach because that's the best way to learn my own systems, and allows me to continue to serve people that I admire and respect. So take good care. That's everything I got for you today. Last call for questions. I'm happy to answer them in a follow-up if there's something triggers, whatever, just send me an email and we'll keep this thing rolling. And I'll ask Phil and Griff to add this to the collection of what I intend to be. Let's do this every month. And you just send your questions to Phil and Griff, and we'll answer them as soon as we can. And we'll record that session every month and get it done that way too. All right. So that's everything I got. Phil, any last call?
Thank you very much for spending the time to describe your systems. And thanks very much for Chris White for having ported your templates into Edgerater, and for his help with us in terms of backtesting, helping us with some of the questions that we have. Thanks.
Yeah, here's what
And
I
thanks
might
everyone
suggest.
for
I'm going to ask
attending.
Chris here to make a comment. But here's something that if I was you, this is what I'd do. There's some amazing charts that came up on the screener this weekend. Listen to what I said. Take a look at the chart. Figure it out. If you got questions about it, take a screenshot, email it to me. I'll record a separate session tomorrow and answer the questions and do a follow-up. Let's do that. That's how we should do this going forward. If you ever send me a chart and ask me what I think, I'll answer it and we'll distribute it. So let's go. All right, over to you, Chris, for closing comments.
Okay, that's great. Yeah, thanks. And that's a great offer. Send a chart to Ken and have some comments on it is amazing. That was so much information. You can see the wealth of information that Ken has available. A lot of it for free as well. You can check out some of those free resources. But this LLM thing with the Google Brain sounds incredible. 1.25 million words in that.
125 million words.
Okay.
Now, here's what that means. The standard page has 200 words. So 1 million words fits into 5,000. 1 million words is 5,000 pages. 125 million words is 675. It's a lot of goddamn words. I mean, here's what I do when I write things and I speak into them. I put them into a PDF, and then I stack those PDFs until it comes up to about 200 megabytes, which is the largest size of a single file that will fit in a Google slot.
Mm-hmm.
That 200 megabyte is about 1 million words. And in my account in Google, I can have 300 slots.
All right.
And I fill it up with about 280 slots, so I keep 20 open for open research. But what I keep doing all the time is merging, compressing, integrating, synthesizing. And what Google lets you do with that brain is every time I ask it a question, it will create a chat answer that reverse engineers a footnote to every source that talked about that was in that data stack.
Yeah,
so every time, and so what I do is I will go through those things, hundreds of questions at a time, build that as an indexed FAQ, stack those until I get 1 million words from that, and add that as a new source. So you can it never misses things. Here's an example. Last weekend, I was doing a coaching session with somebody on psychology, and we were using the concept of the golden bridge as a way to describe a visualization to take us from fear to satisfaction and serenity, and use that improvement in psychology to do better at managing the stress of trading. I had never used that phrase before, but I liked it so much that I did some writing on it, took that snippet, put it into those 125 million words, then queried it and said, tell me what Ken has said about the concept of the golden bridge. It instantly found that, and then found every connection between relaxation and visualization and serenity to all of the things that we've ever said about risk management and managing your emotional state. And it built out an underlying concept and a strategy to improve it connected to the words golden bridge. So not only did it find the concept Golden Bridge. It found a needle in a haystack. It found all the hay in the haystack and pulled it together into a synthesis that had not existed before. So when I'm opening that thing up for you guys to do Q&A, it's not because I'm a good person. I am not. I am interested in making that thing better for my own nefarious purposes. The consequence is that it's also better for you. But I kid, but that's actually what the action of doing question and answer with your local reference base does. It takes individual independent resources and ties them into an integrated nonlinear word web that creates a giant brain the same way your brain works. That's why the Army has me working on this stuff for commander decision making, because we got all kinds of independent information gatherers. What we don't have until now is a powerful way to ensure that we get all of these integrations together and have a better understanding of the complex battlefield. It's the same intellectual challenge that we have as traders. And a lot of the things that I've learned to do in my trading career actually have direct payoff to my guys in the Army. And a lot of the things that I do with the Army has a direct trade-off to the trading community of practice. So I really feel like I'm sitting at a position of privilege to be able to straddle both of those worlds and find ways to integrate them. That's really important. It's my life's work to do that. So please take good care and pray for peace. Pray for peace. That we are in a complex, critical state in the world. That's why I'm day trading and not swing trading, to call back to the earlier one. Anyway, praying for safety for all of you and yours. Let's pray for world peace. And thanks very much, guys. Phil, I'll send you and Chris the link to this once we get it processed. And I will send you a link for it as an audio file as well. Because guess what I'm going to do with the audio file of this? If you thought I was going to add it to the Google Brain, you would be correct. Because there were some things that I said today that I've never said exactly in that way before. And it's going to make our collective brain better. Take good care, fellas.
Thank you.
Yeah, thank you.
Hey, thanks so much, Chris. I've stopped the recording, I think. Appreciate the opportunity.